So I took the women teaching part pretty seriously. I want to teach really the building blocks of technical analysis. So we're kind of going to go back in time, maybe into when you first started to learn this, or if I've got some beginners out there, this should really clear up some of the lingo and all of the different things you really need to be paying attention to when you're looking at a chart, and just some of the basics that I wonder if everybody can remember from their educational experience in technical analysis. So I'm going to get started. My name is Erin Swenlin. I came up through the educational side. I wasn't at a trading desk or anything like that. I studied math at USC, and I got a master's in information resource management. I have about 22 years of studying the markets, but honestly, I could say that it is way more because I used to work with my dad back when he first started following the markets, and he had, he didn't have spreadsheets, he had accounting books. And so I would be helping him calculate the on-balance volume, which I'll talk about a little bit later, with a calculator and a pencil and a ruler. So I've been exposed to technical analysis for quite some time. DecisionPoint.com was founded by Carl and I. We reopened it just recently. I'm the vice president and senior technical analyst there. I also am a consultant for StockCharts.com. I've been consulting with them as a senior technical analyst for 11 years. And I'm on StockCharts TV. If you haven't checked out StockCharts TV, they now have an app that you can download to Roku and to your Apple TV, and then you can watch all of our technical analysis shows right there on your big screen. So recommend you check it out. I host Decision Point Show and Chartwise Women with Mary Ellen McGonigal. It's a great time, and I love my broadcasting time. So what are we going to cover today? And I have a ton to cover. I'm going to kind of brush over some of the concepts a little bit, just to tailor it a little bit more to the audience I have today. But we're going to just go right back to the basics of technical analysis: price bars and time frames, moving averages, support, resistance, and trend lines, some of the tricks to figuring out how to set those. Price patterns. I have a ton of charts here to show you with all of the basic bullish and bearish chart patterns. So I think that'll be a great review for everybody. I'll talk about basic indicators, and I'll go over some of that technical analysis lingo that we like to use. So let's go ahead and get started. Technical analysis versus fundamental analysis. Basically, as technicians, we're using price movement on a chart to really take a good look at, what price will do based on what it did before on a chart. Fundamental analysis, you're kind of looking at those underlying forces, you're looking at earnings, you're looking at what the company does, et cetera, how the environment is currently in the whole state of the United States and globally. All right, so let's start with just the simple representation of price. So again, a lot of people, you kind of look at it every day, but maybe you don't really think about it and what it means. So the obvious, of course, is the open, high, low, close bars. So of course, when it's on the right side, that's the close. When it's on the left side, that's the open, the high for the day, the low for the day. And then, of course, when you're looking at candles, it's a similar representation, only we fill them depending on how they closed prior to the day before. So again, I don't want to go over this in too much detail, just because I know that the audience that I have here today is probably fairly familiar with this concept. But for those of you who are beginners, you can pause this and go ahead and read all of the detail about how we represent price on a chart. Now, the time frames, I actually continue to get asked this question from every investor that I know. What do you mean by long term? What do you mean by intermediate term? What do you mean by short term? Well, here's my basic understanding, or really how I approach it. I think everybody's a little different. But typically when you're talking about a long-term trade or a long-term time frame, you're looking at a monthly chart, you're looking at annual charts, you're looking at years of data to determine what you want to do in terms of your investment. Long-term investments, you do tend to hold a little bit longer as well because they're long-term. You're waiting for it to do what the chart's telling you on a monthly chart. Intermediate term, I use weekly charts. So that's, you're talking intermediate term is usually, weeks to maybe a month is how I look at the intermediate term. Short term, I'm looking at daily charts. I think of the short term as days, to maybe a week or two. So when you're talking about a short-term trade, you're looking at those daily charts and you're really setting up a trade for maybe a shorter term, meaning you're going to hold it maybe a couple weeks at most. So that would be a short-term trade. Ultra short term are your day traders. And honestly, I use these charts for my entries and exits. I learned quite a bit from you, Anka, when you did come and visit. And I've tailored my investing to using these ultra short term hourly and minute charts to time my entries and exits more so than for trading in the day. So that's pretty much what I would call those time frames. Moving averages. There are actually 3 types of moving averages. Of course, there's a simple moving average, and that's pretty much what you learned in school. Take all of the data points, add them together, and divide it by how many there are. But we use at DecisionPoint an exponential moving average, and I won't get into the calculation, but what it does is it puts a little bit more importance on the near-term data. So in terms of that simple moving average, you're kind of getting an average of everything, and every data point has the same power as the one before it. But with the exponential moving average, we really weight it toward the end game, the end data set. So I like to use it on my charts. We have our trend models using the EMAs just for that reason. We really want to concentrate and give more importance to the data that just happened. I don't want to be worrying about a huge drop, that we had maybe, at the beginning of my data set that's skewing that simple moving average. And when it drops off, that's going to change your moving average a lot more than it's going to change, say, an exponential moving average. Weighted moving averages, same idea, only you can pick which area you want to weight your average. Not many people use those, but you certainly can. Trend lines basically are rising bottoms and declining tops. There's no such thing as rising tops and declining bottoms as far as trend lines. Obviously, they happen on the chart. And then there's one that people aren't generally familiar with called an interior trend line. And then, of course, you have your support and resistance lines. Those are your horizontal ones, and I'll talk about that a little bit more. And then, of course, there are your trend channels and a trading channel. Very simply, here's what we've got going on. First of all, there's those moving averages I was talking about. I use a 5-day, a 20, 50, and 200-day EMA. A lot of people will use the 20-day EMA and then keep the others as simple moving averages. But again, like I said, the way I study charts, I want that near-term data to matter a little bit more. So here's here's a support and resistance line, right? So it's support back here. Obviously, it's supporting price, and resistance, this is where price is coming up and having trouble. Rising trend channel. You could draw a declining trend channel the same way, just obviously it's declining. And then you have declining tops. And like I said, you don't follow declining bottoms. I mean, you can, there they are, but that's not what we're looking at. With declining tops, we're more interested is when this particular downtrend is going to be broken, and that's going to happen when something breaks above the tops, not the bottoms. Just a simple way to think of it that way. An interior trend line I've drawn back here. So what you can do is you're not really lining it up with your tops or your bottoms. You're lining it up really just from a top down to a bottom, and it'll it'll come right through the price action, but it gives you just a basic idea of what's going on as far as that trend. Again, I don't see these that often, but you know, there's something you can do. I've got the support line. I say it's in green because every time the price is above this line, it's green, but you can see when it goes below, then it is red. This is the support resistance line that you can use on stockcharts.com. All right, let's get into the chart patterns because I think this will be a little bit more interesting for all of the more intermediate term traders that are out there. And again, I think you're very familiar with these chart patterns, but maybe you don't know the details of them, or maybe there's a few you weren't really familiar with. The ascending and symmetrical triangle, you're going to see symmetrical triangle on the bearish chart patterns too, because a symmetrical triangle can break either way. But we have also the ascending triangle. There's a bull flag, the falling wedge, doubles and triple bottoms. I think people are fairly familiar with those. The cup and handle, not everybody is familiar with the cup and handle. I'll show you that one. And then one that we don't talk about very often is a V bottom. And the V bottom became really popular, in my opinion, when we had the bear market, because we ended up with a very quick decline, and in a lot of cases, a very quick rally to, you know, to new highs. So you ended up with this V-looking shape. Well, it's actually a chart pattern. I'll talk a little bit more about it when we get there. Like I said, I know I have a short amount of time. In fact, I want to make sure I got my clock on here so I can be sure to have this end at the right time. All right, great. Okay, so this is the ascending. Let me get my face out of the way so I can see what's going on. This is the ascending triangle. So it's a triangle formations. If you think about it in terms of geometry, the ascending triangle and of course the descending triangle are right triangles here, because the top part is horizontal on an ascending triangle. And the bottom, of course, you have rising bottoms. So the idea is that typically this is going to be a continuation pattern, meaning it's going to come off of a price rise, but you can sometimes see them as reversal patterns as well. You're looking for that upside breakout when you see these triangles. That is your expectation. That's why we want to learn about chart patterns, because they tell us what to expect just based on how the price action is going. They're formed a lot of times just by the psychology in the market. For example, you know, we hit overhead resistance, we started this next drop, and then notice we came up here and couldn't get past that resistance. It's kind of a psychological thing with traders. They know that level. And then you started to see it move down. But the main thing is as you're coming down, you're not going quite as deep each time. And that tells you that traders are getting more bullish about that stock. So you want to expect that upside breakout. We talk about calculating minimum upside and downside targets. And not all patterns can you do that with. The ascending triangle is, you know, in the textbooks, they don't talk about using measurements. But I've found that if you measure the back of this triangle from that bottom to that top, that length, when you get the breakout, you can generally expect the breakout and rally to be the height of what that pattern was before. So in this case, that's about what, 3 handles as we call it. So 1, 2, 3. So our upside expectation was right around here. Obviously it went past that. That's why we call them minimum upside targets, because they can go higher. All right, here is a symmetrical triangle. And the difference between the ascending triangle and the symmetrical triangle is that the top part is a declining top. So you end up with sort of this arrow, you know, formation where each of these lines are converging into an apex. But with these triangles, you don't want to see price go all the way down to an apex. That pattern just isn't really going to be too helpful for you. Usually you want to see those breaks in either direction before you get about 2/3 down in a pattern. All right, so here's the symmetrical triangle. These are typically a continuation pattern, meaning they're going to continue the trend that happened before them. So here you have that breakdown, and of course we see the continuation down. Typically 3 weeks in duration. I don't pay too much attention to the duration because you can find these patterns on a 5-minute chart. You can find it on a monthly chart, and really the duration doesn't seem to be the issue. The main thing is you want at least 2 touches on top and at least 2 touches on bottom. So that's how you draw your trend lines, right? You have to have at least 2 points, and those need to be at reversal points. So, if you're watching price come up here and you haven't set a top, you really can't draw your trend line there until you've actually set the top and it's moving down. Hopefully that makes sense. And then I have all of the price momentum oscillator. I'm going to talk about momentum a little bit later and volume, but just to give you an idea, you had this triangle forming, and right near the end, the momentum started to pick up to the upside right about here. But when it failed, so did your momentum indicator, and you got that negative cross. So you knew more than likely we were going to get that breakdown like the pattern suggested. Bull flags. These are flagpole and a consolidation. You typically would like to see these consolidations of the flag itself kind of pointing downward. Typically when you get these flags that are trending higher, they just don't tend to work out the same way. And I think it's just because, you're in this declining trend after a big move upward. And, the opportunity for the rally and an actual breakout, because you started a declining trend, I think is more powerful. When you get the rising flags, it's kind of hard to figure out when the breakout happens. But these are great for calculating your targets. All you have to do is take the length of the pattern, that flagpole, and add that height to the breakout point. So the minimum upside target of this particular pattern is right about here. And you can see that price did end up getting there. The issue, of course, is when you look at this, we got the breakout, but we didn't immediately get to that upside target. We had to endure quite a bit of decline. But again, this is where your momentum indicators can give you that hint that, okay, it might be time to get out. You can keep this pattern in mind because, again, it suggests that you're going to see later on that breakout. But you can see these patterns bust. You've got a flagpole here, and there's that declining flag right there. Got the breakout, but it failed. And again, here's your momentum. It kind of gives you the hint that this wasn't going to go well because even on the breakout, you were getting this sell signal here. So you really want to kind of combine the two. The falling wedge, you've got 2 declining lines. Of course, one is the declining tops and the other connects those bottoms. These are reversal patterns, and it maybe doesn't seem intuitive, but when the wedge is falling, that's actually bullish. Remember, we're trying to break a declining trend. So you get that wedge, you break out. This was a nice gap actually on that breakout. And then you're supposed to expect, again, you could kind of do a back of the napkin measurement of the back of this pattern, which is only about 1.5 length there. So about 1.5. So we'd be right about here for the upside target on this particular pattern. But obviously we went well past that. And again, watching your momentum is going to help you stay in the trade or get out or not trust the pattern. Bullish double bottoms. Now, interestingly, back in 2015 and 2016, the S&P was quite volatile. And interestingly, it formed 2 double bottoms here. So you have this first one that came in, there's 2 bottoms. It basically shapes a W, right? So the confirmation line comes in right at that last close that forms the middle of the W. You can measure the pattern and get your minimum upside target. In this case, price almost hit it. And then you can expect, that breakout. And again, you want to know those targets because that helps you set your targets when you invest. And here's the other one and the measurement, and it did end up hitting that target. Cup and handle, like I said, this one isn't talked about a lot. And in this case, you could probably make the case that it could be a double bottom, but because we had that move down here and overall, you're looking for a rounded bottom right here. And you'll find these on various charts as price decides to bottom in its oversold territory. We'll talk about oversold later. And then we have a handle. So you get the rounded move and then price breaks down. In this case, you can see the moving averages probably were causing resistance. And so you get this pullback here. And then the expectation when you get these cup and handles is, of course, a breakout. And I don't usually do measurements with the cup and handle. I'm more interested in the breakout point. I don't really think there's an official measurement. I suspect that if you took this height right here and added it, you'd probably be pretty close to what an upside target would be. This is a chart I pulled yesterday, so I just wanted to, 2 days ago. So I'm just pointing out here, this could possibly be a bearish head and shoulders, but we'll get to that. Here's the V bottom. And like I said, you can see one back here. A lot of these are occurring right now. Volatility, of course, contributes to this. So you get the V and you start to travel back up because we don't know what happened over here. So you get the V, you start traveling back up. Once you get about 1/3 of the way to trace this side of that V, which would be right around here where you have that consolidation, interestingly enough. And the expectation after it retraces 1/3 is a breakout past the top of that left side of the V. So indeed, this one broke out as expected. You'll see on a lot of these charts, the patterns that I pick, typically they execute as they are supposed to, but that's because I'm giving you examples here. Obviously, they don't always do what they're supposed to do. But more times than not, I find that it does. And it certainly gives you insight on a chart as to how bullish maybe it is or how bearish it is. So let's talk a little bit about the bearish ones. So we looked at an ascending triangle and that was bullish. Now we're going to look at a descending triangle, which is bearish. And again, I put symmetrical triangle because yes, typically they are continuations, meaning if we're coming down, a symmetrical triangle in a declining trend is going to suggest that you're going to get more decline. There's the rising wedge, the bear flag. These are just opposite what I showed you earlier for the bullish ones, double, triple tops instead of bottoms. The head and shoulders, which I hinted at on that other chart. A broadening or a megaphone pattern. Again, this is one that maybe you haven't heard of or that you're not familiar with. And the parabola. This is a very important one, and I never see this one discussed. I think my father, Erin Swenlin, and I are really the only ones who discuss parabolas, and they are really important to know as a bearish chart pattern. All right, so first off is the descending triangle. And again, remember it's opposite the ascending one. So we have the flat, it's a flat bottom instead of a flat top. This is your support. You see that price is moving ever lower in a declining trend on the top. So that is your psychology, is that you form this area of support and every time you come down, you seem to land and hold that support, but every time you come back up a little less high. You end up with tops that are lower. So the psychology is that this move is probably starting to be exhausted, and the expectation is that this support is going to eventually fail. And again, you could do a measurement, the back of the pattern, that could give you your minimum downside target, which would be around here. Not surprisingly, at a support level, you'll find that a lot when you do these measurements. So at this support level, so our expectation is we're going to get a drop at least this far. So perhaps you were shorting this stock, you know now kind of the level that you should expect it to go to at a minimum. But when you get to that level, here you can see a rally starting. That might be your clue to go ahead and take any profits on a short. Ascending wedges, again, opposite. And remember, I was thinking, wow, if it's rising, shouldn't that be a bullish pattern? No, 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 no. We have a rising trend and it's going to be busted. So that's bearish. I find a lot of rising wedges. In fact, right now, the S&P 500 is in an intermediate term rising wedge. If you read some of my articles or watch the DecisionPoint show on Stock Charts TV, we talk about it every week right now because that pattern has been in there. But the expectation, I'm sorry, I kind of moved back past that one pretty quick. The expectation on this is the breakdown. And again, you could measure the back of the pattern. That would tell you your breakdown would have been at least down to this support level. But of course, we moved even lower. Kind of spy a little bit of a triple bottom here. And then we got the breakout on that side. You'll see a lot of these patterns repeat themselves. Here's a double bottom right here, but that one never executed. It failed right back here. And like I said, they don't always work. The reverse flag is obviously the reverse of what we saw earlier. And again, same idea, measure the flagpole. When you get the breakdown, your minimum downside target should be right around the length of this flagpole. In this case, you could see that price never really hit that downside target. And you had a clue right here. You had all this decline in momentum, and then, oh, all of a sudden it's starting to turn up finally. Got a little failure here, but ultimately you see these rising bottoms on the PMO, my price momentum oscillator. Again, talk about that a little later. And you can see these declining bottoms here on price. Now, I wouldn't draw a declining bottoms line. Like I said, that's really not that's not a real thing. But it does tell me that we have these rising bottoms in comparison to those falling bottoms on price, and that's positive. So the expectation here would be a rally. Of course, it was kind of short-lived. Bearish double top, again, back to that S&P 500 from 2015, pretty standard here. We sometimes will call these tops where you get a spiked top first and then a rounded top as your second one, as an Adam and Eve double top, for obvious reasons. And you can see that we didn't actually get the breakdown. We had a little bit of volatility that happened after that, but eventually we did get the breakdown and it did go down the length of that pattern. And again, watching the momentum as you're traveling in these patterns, I think is pretty important. Triple top, this was a beautiful example. When I ran across this one, I was, wow. And it did exactly the way it was, it was intended. So you had this double top form. So right around here, you were probably thinking, we're going to get the breakdown, right? It's a double top. Well, instead, it did find support and came back up, but then it came up to this resistance level. It's just amazing. It's usually not quite so on point here. But you can see we got to that resistance level a third time and then started to fail. You can see momentum was still failing as we were moving through here. And then we ended up getting that breakdown, and the minimum target is down here. And funny enough, it's landing on a support level. Again, you'll find that happen a lot. The head and shoulders pattern. This, of course, is, the one I think most people know. It's a pretty obvious looking pattern with a head in the middle, a left shoulder and a right shoulder. There's all sorts of calculations and, You know, you can look at the volume to confirm the pattern. But really the pattern doesn't become a pattern until you get the breakdown. And we call, instead of a confirmation line on the head and shoulders, we're looking at a neckline. When it breaks down below that neckline, which of course is drawn at this low, right between the head and those shoulders, that is your confirmation line. As soon as it dropped below on the neckline, right there, that confirmed the pattern. Now, again, as I said, head and shoulders, it's kind of a love-hate relationship. I look at them as, okay, it's a topping formation. But what I find is so many times those minimum targets don't get hit for whatever reason. And you can see we got the breakdown, which was expected. So, and that's what I need to know. But we never really got down here to test that target. And again, if you watched momentum, you could see that shifting back here. And that gave you an idea that more than likely the decline was over. Hopefully I'm not going too fast. I'm gonna have to take a sip of coffee here. My voice is losing it. All right. All right, the broadening pattern or megaphone. Again, we don't talk about these that often, but I can tell you if you go look at the weekly chart of the SPY, you will see a nice giant megaphone there, and those are bearish. They measure the fact that they're bearish is, you know, you're increasing your volatility. Every time you go down further. Every time you're going up further. This is a good sign. Now this is a bearish pattern, but this is a good sign that it found support here at that 50 and it didn't have to go all the way down. So to me, that tells me that, okay, maybe this pattern is going to be busted here. We are still struggling with overhead resistance here. And I believe this was this one I pulled 2 days ago as well. So it's a bearish setup here. But I can see momentum, we just got a positive crossover. But knowing that this is a bearish pattern, I don't think that I would want to get into this one just because of that broadening pattern. There's still a little volatility going on there. The parabolic, this chart I borrowed from my father because Apple over the years has gone through many, many parabolic moves. Now, the parabolic, as you can see, is, you know, and I think most may be familiar from geometry, is you basically have this ever increasing steepness or rise in what what the price pattern is. So for example, we're in one right now. You know, if we can see here, if we were drawing these rising bottoms trend lines, we'd have one this way, and then it would increase and get steeper here, and then it gets steeper here, to the point now we're almost vertical. Now, the problem with parabolas is, okay, number one, they're fun. If you get in one, take advantage. But, you know, if you were in Gamestop, if you were in AMC, even Bitcoin to some degree, if you had set just a trailing stop of maybe 15%, you could set a pretty wide trailing stop. Parabolas are the best time to use these trailing stops because they move too fast. You're not necessarily going to be able to get in there and raise your stop every day. So I set the trailing one, it goes up with me. And then when you get the breakdown, which almost always is very swift and very painful on these parabolas, I'll be protected. I may lose about 20% on the top end, but I'll tell you what, in GameStop, 20% down from the top, I would have still been extraordinarily happy. Short anecdote, my stepson not called me, he talked to his father and he says, yeah, I'm getting ready to buy GameStop. Well, I looked at the chart at the time, it was pretty ugly. I mean, and so I told him, okay, well, you know, be sure to set stops and, you know, watch it. Well, apparently he was one of the Reddit kids, or at least he saw it. He wasn't involved in stirring the pot, but he ended up doing quite well. And I told him to set that stop, and he was able to get out with quite a bit of that profit before everybody else and lost because, again, parabolas. Just keep an eye out on those charts. Like I said, if you're involved in one, hoorah, yay. I love it when I get in those. You don't always know that they're going to happen, but get that trailing stop in there. I can't stress that enough. It has saved me so much in the way of profit. I mean, I've gotten so much more profit because of it. All right, so let's talk a little bit about volume. And again, I'm getting kind of in the nitty gritty, so maybe some of you intermediate folks are familiar, but maybe wanted a refresher. Advanced folks, well, hopefully this is a good refresher for you. Each unit of volume, so when you see volume and it says, 40,000 shares were traded, that represents the action of two people, a buyer and a seller. So one person, of course, sells it, the other buys it. That's one unit of volume. Each one of them isn't a unit of volume, just the actual transaction of a share. So volume is the number of shares or contracts traded. So again, it's not just, I bought, you sold, and that's a unit of volume. It's like, well, how much did I buy and how much did I sell? It really is a great reflection of the financial, but also emotional involvement of people. When you see that rush in volume, that tells you something emotional is going on there. People are excited and everybody wants in. And those sentiment-wise aren't usually the best of trades if you get in them a little late. Some of the indicators that we use, on balance volume is one. That's the one I prefer to use. There are a bunch of different measures. These are kind of the main ones. The accumulation distribution line is one, and Chaikin money flow. These are both kind of related. The Elder Force Index is another one. Dr. Alexander Elder, he has some books out there, highly recommend it for the beginner to intermediate investor. And then there's volume by price. I'm not going to show you that one, but that one's quite interesting as well. So here's a chart really with with three of those measures. The easiest one, and probably one of the reasons I use it, it's very simple to understand. So the on balance volume line, each day we look, if we had a positive close, the amount of volume for that day is added to the line. If it's a down day, the amount of volume of that day is subtracted. So you can see there was a lot of down days right in here. And so the OBV line was moving lower. And you could, by the rate of speed that it lowers, that tells you, again, a lot. You can see it was very similar with accumulation distribution. The difference is that with accumulation and distribution, it looks at the range for the day. And if it's traded above the range in by a certain degree, there's a certain multiplier. The issue I have with accumulation distribution is that you could have a down day, a serious down day, but if you closed in the top of the range, your accumulation distribution line is still going to go up. So I like its simplicity for the on balance volume. Like I said, I helped my dad calculate it back when I was in high school. It's very easy to understand. Momentum is the other important one, and I did talk about that on some of those chart patterns. The momentum basically is analyzing the changes in price, not necessarily what price is at, but just the changes in price. It establishes your formulas about speed, movement, and especially the rate of ascent and descent, which is why sometimes you'll hear, back in high school, the slope intercept, the slope is the ascent or the descent and a measurement of that. It's also known as a rate of change, or an ROC in technical analysis lingo. Again, it's the rate of the change, not necessarily just the plus and minus of price movement, but it's measuring the actual momentum, which is what I'm going to show you on the next chart here. These tend to be leading indicators, unlike the moving averages, which tend to lag a little bit. So one of the reasons we really like using momentum on our charts. I talk about the price momentum oscillator, not always familiar to everybody. This is the decision point version of momentum. And it's calculated slightly differently. We like it better. We think it's the best. But you can also look for the moving average convergence divergence, better known as the MACD, and the price percentage oscillator, the PPO. It basically, the PPO turns the MACD into a percentage so that you can bound the results. With the MACD, it can go way up in some various, numbers and below, but you can normalize it, is what we call it, by turning it into a percentage. The PMO is very similar. It's bounded as well. And then there is the relative strength index, not necessarily a measure of acceleration, but it does measure where price is currently in relation to where it was previously. So it is a rate of change kind of indicator. And then there's stochastic. I won't get into stochastic. I don't use stochastic, but the people who do, I know Mary Ellen McGonigal, my good friend, does use it. And, hey, you find what works for you on your charts and use it. All right, so let's look a little bit at these oscillators. And you can see that they have a very similar look. These two are pretty much identical because, again, like I said, you're taking this one and normalizing it by turning it into a percentage. So it's basically the same type of indicator. I would say if I didn't have my PMO, I would prefer the PPO, just because mathematically I like the beauty of it. What can I say? Math major. The price momentum oscillator, again, that's what DecisionPoint uses. So let me explain in less technical terms about momentum. So what we're measuring, right, like I said, is the rate of change. You'll find a lot of times that you can see how this is flat, but when you're starting to see that move to the upside, this measurement isn't just measuring kind of the change between price, it's measuring the acceleration. Momentum is the acceleration or deceleration. So in this case, think of it as your foot on the accelerator. When you push down on the accelerator, you're going to start going up a little bit faster. That's what's going on here. Your foot's on the accelerator. It's continuing on the accelerator. You're pushing down further, further, further. Right here, when it turns over, let your foot off the gas. So it's just, you're going to start to sail this way. The other way, again, is with the deceleration, same idea. You're just accelerating downward. Again, take your foot off the gas and you're going to flatten out. One of the other things to think about with momentum indicators is that when you do start to get sideways price action, that's when the PMO is going to turn lower. Your momentum indicators will turn lower, even though you're just moving sideways. That's because, if there's no acceleration, the momentum indicators tend towards zero. They tend to move themselves towards zero. So it's not necessarily a bad thing to see the deceleration of momentum when price is moving sideways. In fact, I think that's somewhat positive, because this means this indicator is working out those overbought conditions. All right. I think that covers that. So let's talk a little bit about divergences. And there are a few, of course, positive divergences and its partner, a bullish confirmation, negative divergences and its partner, a bearish confirmation. And then there are reverse divergences. I'm not going to talk about these. It's a pretty advanced concept, but if you want to learn more about it, I'll give you some references at the end of this. I know we're getting short on time. I think I'm still pretty good as far as my, what I'm covering, but we'll just move through. All right, so a positive divergence. So here's a price and here's the indicator. Remember how I said there's just rising bottoms, not declining bottoms? Start with the indicator. Start with the indicator. When the bottoms are rising, Then you look at price, right? So rising bottoms. You look at price, rising bottoms, but now you can see the bottoms on price are moving lower. So this is actually a positive thing, right? Because your indicator is telling you, let's say this is momentum, that momentum is actually starting to pick up under the surface. And even though price is moving lower. So that means this one's a sleeper, right? We're probably going to see a move to the upside, and it might be very strong because we had that positive divergence. These are just really representations of what happens with the indicator and what happens with price. So here's your, I call it a regular bearish divergence. Like I said, I talked about reverse ones in the other one I did, but a bearish divergence, again, start with the indicator because we know declining tops are a thing. So you have the declining tops on the indicator, and then go ahead and look at price. So declining tops, rising tops in price. I like this one really to use with volume. So if my OBV is starting to show lower tops, that means less volume is coming in and price is still rising. Price should follow volume, okay? And if volume is starting to diminish, price is going to follow that. So this is going to give you that hint that something maybe isn't going to go right on your chart. So let's look at, this doesn't have anything marked up on it, but I wanted to just show you a few that I noticed right away this morning. You can see I just pulled the chart. So the first one I'm going to talk about here is these rising, again, we're looking at the on-balance volume. We have rising bottoms, right? But we have declining bottoms here. That is a positive divergence. So when you see that increase in volume, that increase in interest, again, remember it's an emotional component. You're starting to see a lot of interest here, but price hasn't done much, right? And in fact, pulled back again. But when you see that rising, the rising bottoms on volume and the declining ones, that tells you something good's going on under the surface. You'll see probably far more negative divergences with price. I'm trying to think if I can see one right off the bat here, but typically you'll start seeing price rise, but then you're going to see the volume start to decline. You have those declining tops. I think I believe we have a negative divergence going on with the S&P right now. Don't hold me to that, but so that's just, I wanted to give you kind of a basic look here at what a positive divergence is. Like I said, you're going to see negative divergences far more. You'll see declining tops on the OBV all the time and rising tops on price. And again, if you don't have that volume underneath the surface to keep price pushing higher, more than likely it's going to fail. All right, let's talk a little bit about our technical analysis lingo that you hear all the time. And again, I think most of you probably are familiar with this, but for those that are more beginner, I think this is helpful. But we talk about outperformance and benchmarks. The typical benchmark, this is sort of what you want to do better than, basically. It's your benchmark. You want to get at least as good as your benchmark. And it's even better if you outperform it, you move above your benchmark of success. So, typically we use the S&P as a benchmark. So you want your portfolio to do better than the S&P. If it's not, and a lot of people will say this, they just throw all their money into the SPY because they find that they just can't outperform it. My sense and my portfolio will tell you that using technical analysis, you can outperform the SPY. Takes a little work, but you can definitely do it. The symbols you're going to find sometimes on stockcharts.com in particular. When you see the dollar sign in front of a symbol, that typically means it's an index. If you're on Twitter, though, or some of social media, the dollar is just used there to kind of like a hashtag so that people know what the stock is. The main one I want to talk about is the exclamation point. You don't see that one too often. On stock charts, when you see the exclamation point in front of a symbol, that means it's an indicator. It's not an ETF, it's not a stock or an index. the decision point indicators all have these exclamation points in front of them. Buy and sell signals. Obviously, the buy signals are like crossovers, like that PMO, when we get that crossover, that's a buy signal. A sell signal, similarly, crossovers to the downside. But we also have neutral signals at decision point, and that mainly means you get a negative crossover, but it's above a, so for example, a 20, 50-day EMA negative crossover. If that occurred above a 200-day EMA, that would be considered a neutral, because, you know, overall, if the 50 is above the 200, it has a bullish bias on that chart. So rather than to go into a full sell signal, we choose to do a neutral, which means basically you're just out. You're not in the stock, you're not in it. You're not in it, so you're fully hedged if you are, or you're in cash. Sell into strength. I recommend this right now. I think everybody knows that the market is overbought, ready for a downturn and a breakdown. So when we start to see price move higher, that's your point that you want to sell. You want to sell into that little bit of strength that might be left. And then that way you'll be protected when it turns back down. And we did talk about divergences already. I call it the Vixen breath. The VIX, volatility index, and breadth. I didn't really get into it with a chart. I just don't have time today. But I'll tell you how you can get in touch with me to learn more about that. So let's put it all together on a chart. Let's analyze a chart. All right, so let's see, what do we have going on here? Okay, so chart patterns. Well, here's a symmetrical triangle right here. We have a flag going on right here. And I do believe this is, yep, this is a chart that's trading right now. So we have a bullish flag. You can see this is your resistance line. Came back here, it was originally support. It was a resistance back here where price turned back down. The more touches you can get on a support or resistance line, the better. That tells you how strong that level is. So bull flag, our expectation is a breakout. And you can see momentum is on the buy signal, came in around here. It's still moving upward. It's hard to tell here on the chart, but it is moving still to the upside, even as price is sort of trending down here. So honestly, this chart looks pretty good. You can, I guess, say this is my stock pick for the day for you guys, an actionable one. I'm not a financial advisor. I can't give you a call to action, if you will, but this one looks bullish to me. Here's a trading range right over here. We have the different moving averages, right? So back here, the 50 crossed below that 200-day moving average. That gave this whole chart a bearish bias. That's a death cross when the 50 crosses below the 200. However, when it crosses above it, that's the golden cross. That now takes the bearish bias off the chart. Now it's more of a bullish bias. You can start expecting bullish outcomes. Let's see, what else do we have? I like to use these vertical lines to line up with cardinal tops and cardinal bottoms. And the reason I like to do that is then I can look down here at the indicators and see what's going on right before a bottom and right before a top. So that helps you. You can see right here as far as the on-balance volume goes, pretty much right on. You can see when the bottoms come in on volume and as it's turning back down, there's that problem as well. Here's that relative strength index. When it's above 50, that means that it is in positive territory and that price is in the upper 50% of its prior price range over the past 2 weeks. You can look up the formula, but basically we want to see the RSI between 50 and 70, that's positive. You notice it sometimes gets into these shaded areas. Well, look at when those shaded areas occur, what happens to price after? I mean, cardinal top here, cardinal top here, cardinal top here. So you don't want to see it sitting up there in that shaded space for too long. Let's see, what else can I talk about on this? There's your 20 and 50-day EMA positive crossover. Those are positive crossovers are always buy signals. So that one came in near a top, so that wasn't very helpful. But we did get notice that there might be some problems with the momentum turning down, and of course with volume. The distribution that occurred there was pretty high. The symmetrical triangle, this one broke upward. Normally they're continuation patterns, but like I said, they can break either way. And in this case, it busted. Just a short mention as far as busted chart patterns. You want them to, of course, fulfill, right? So here is a bullish chart pattern. Well, if this were to break down and not do what it was supposed to do in a bullish fashion, if my bullish chart pattern is broken with a breakdown, that is especially bearish to me because the pattern was set up. It was very bullish. So if the pattern busts to the downside, that I find especially bearish. But if it's the other way around, you have the symmetrical triangle, it was supposed to go further down, but it broke out to the upside. That was your clue that it's more, I find it especially bullish when a bearish chart pattern is busted. So something to keep in mind. Getting short on time, so I'm going to finish it up. Again, my name's Erin Swenlin. For those of you interested, I do a free trading room on Mondays from noon to 1 during your lunch hour on the East Coast. And I answer your questions. So if you saw a chart like this and you had a question, I'll answer it real time. I take your symbol requests so you can see how I analyze charts. I do entries and exits using the shorter term candlestick charts. Again, free. Just go to DecisionPoint.com and you can sign up for our free newsletter and you will get the registration information for my free trading room on Mondays. I love it. I love my trading rooms. I love it so much that on my subscriptions for my DecisionPoint Diamonds, I do a subscriber only trading room on Fridays. I just love talking to you guys, especially now with, not being able to get out and go to conferences. So these are the two products that I have. The DecisionPoint Alert is about the market in general, but we cover the big four, we call it dollar, gold, oil, and bonds. You can read the DecisionPoint Alert seriously in less than 10 minutes, probably 5. We keep it very concise and you'll get everything you need to know in like 5 or 10 minutes max every night. DecisionPoint Diamonds, that's where I do my stock picks. So for you traders that are interested in those, that would be the product for you. Right now I'm offering a coupon code 20% off. This is what I offered during Christmas. So this is a really good discount for you. If you just want to try us out, use the coupon code DPTrial2. And here's what I mean by savings on 20%. This is the best package. Obviously, you get both of them, but 20% off makes it a lot more, I think, beneficial or cost effective, if you will. All right, that finishes it. If you want to get in touch with me, Erin at DecisionPoint.com. I have had a blast talking to you all. Anka, I'm going to pass it back to you.